So let's now take a look at the learning objective 9. Learning objective 5. Prepare a statement of changes in the equity shareholders' equity. Statement of changes in shareholders' equity. This is required for all the company's following efforts. Okay. So you're going to show changes on the contributed capital, returned earnings, and possibly contributed surplus, and accumulated other comprehensive income. If you company follow ASB, ASPE, you will continue to use the statement of return earnings. So note that the title of the statement is different. Under efforts, the title is Statement of Changes in Shareholders' Equity, but under ASB, it's Statement of Return Earnings. So let's take a look at one example. So this is an example saying how each thing will be affected. Okay, so when you issue capital, share capital, so you will increase either your common shares or preferred shares. Reacquisition of share capital, you're gonna decrease your common shares or preferred shares, okay? And contributed surplus may be increased if it's good news, okay? But if it's bad news, the contributed surplus, if there's a balance, will be first decrease, and then the remaining will be the decrease of return earnings. Correction of number 3, correction of a prior period error that affect prior year's ending balance. So remember we mentioned that we are going to make that adjustment on the opening of return earnings, okay? If last year the earnings is understated, okay, earnings is understated, so we need a credit return earnings. If the last year is overstated, the income is overstated, we need a debit return earnings, right? Effect of a change in accounting policy on the prior year's ending return earnings. When we change in accounting policy, you have to go back to the previous years to fix everything. So therefore, return earnings will change, either decrease or increase. Profit loss for the year. If it's a profit for the year, the return earning will increase. If it's a loss for the year, return earnings will decrease. Number 7, cash dividends are declared. Return earnings is decreased. Number 8, stock dividends are declared. Return earnings is going to decrease, and that liability will be set up. Stock dividend distributable is increased. Stock dividends are distributed, your liability will decrease. Stock dividend distributable is decreased, and the common shares is increased. That's the time you issue the common shares to the shareholder. Stock split, no effect on accounts balance. The number of shares issued will increase. Okay, so does this make sense?
Yeah,
it makes sense.
Awesome. Okay, let's move on to the last learning objective today. Explain the earnings and the dividend performance and calculate performance ratios. The first one, performance ratios, is earnings per share. So obviously, if you just tell by the name of this this item, earnings per share. So basically, it's going to tell you what is the earnings for each outstanding common share. Okay. It is required under IFRS, but not required under ASB. So how you do that? You use profit minus preferred dividend divided by weighted average number of common shares issued, and that equals earnings per share. So you use, because this is for the common shareholders, so you make money, but that money first has to give preferred shareholders dividend. Whatever left, that is the profit for the common shareholders. Okay. So profit minus the amount of preferred dividend divided by weighted average number of common shares issued. So that is your earnings per share. Is that clear?
Yeah.
Okay.
Yeah.
Good. So how to calculate earnings per share? The numerator is the profit, right, minus preferred share dividend. Okay. And now this is the numerator, right? That's the numerator. The denominator is called weighted average number of common shares. Okay. So the question is, what if I buy a share for the fiscal year on day one? Okay. But what if I bought the share at the last day? Okay. So when we think about how many number of shares outstanding in the market, right? Because that's what we are looking for, the denominator, do the calculation. Because the number of shares in the market is changing all the time, right? You issue the new shares, you retire the shares, right? So the number of common shares is changing. Now, when asked what is the average weighted number of common shares, what does that mean? Is they considered the time weight, okay? If the shares is with the company, if one share is with company 365 days for the whole year, well, that one share is considered as one share. What about you buy a share in the middle of the year? Okay, so that share is only outstanding for half a year, right? If you think about the time weighted, so you're gonna put a weight of 1/2 or 6 months or 12 months to recognize how long you are holding the share as the weight, okay? If you, let's say, buy the share on the last day, right, of the fiscal year, and you actually only owned that stock for a couple of hours, so maybe the weight is 0. Right? So now let's take a look at this. Okay, so from January 1st to April 30th, that's the 4 months. You have a beginning share of 100,000. And remember, it's only 4 months out of 12, right? From January to April. So you use the weight of 4/12, or a third. So the weighted average is you apply the weight to multiply to the actual number of common shares. So a third times 100,000 is 33,333. On May 1st, you required shares. Okay. And you reacquired 75 shares. No, sorry. The cost of the required share, okay, this would be 7.5% of the shares were reacquired. So the number of actual shares is only 92,500 because you reacquired 7,500 shares back. So for the period on May 1st, for the period May 1st to September 30th, the actual number of shares is only 92,500. And so this period has a weight. So May, June, July, August, September, okay? That's 4 months, right? That's 5 months. So May, June, July, August, September. So that's 5 months. So I'm going to apply a 5/12 to the balance of 92,500. And then October 1st, issue the shares, 10,000. So your new share, actual number of shares is 102,500. And you hold it until the year end, right? So October, November, December, right? January. So that's kind of the 3 full months, right? October, November, December. So that's 3 full months. So the weight is 3/12. So now I calculate all my weighted average. I add them up. I get 97,500. So the average, weighted average of this common shares is not 100,000, is not 92,500, it's also not 102,500. The weighted average number of common shares is 97,500. Okay, does anyone have any question?
No, any question? No questions.
Okay, Anna?
Yeah, I'm good too.
Okay. Earnings per share, you could also calculate diluted earnings per share because the capital structures can be very complicated, but I'm not going to talk about here in this course. It's too complicated. I used to teach this one to the intermediate financial accounting students, okay? But at your level, I think it's very challenging. Earnings performance, another ratio is called a price to earnings ratio. So you use market price per share divided by earnings per share. So the numerator is the price, the denominator is the earnings per share. So that's how they figured out the price and the earning ratio. The high issue means the company, if the issue is high, that means price is higher relatively. That means the investors have confidence over the company. Paid out issue. So you have a cash dividend divided by profit. That's your paid out issue. So let's say your profit is $100. You only gave say $7 cash dividend. So 7 divided by 100, so that's 4%. So your payout ratio is actually 4%, 7%. That's it.